In this presentation, you will learn about auto insurance or motor insurance, also called as vehicle insurance. Vehicle or motor insurance is one of the largest non-life insurance businesses in the world because this insurance is statutorily mandatory in most countries. The primary usage of motor insurance is to provide protection against losses incurred as a result of an accident. Motor insurance is required not only to cover risk towards the owner and the vehicle, but also to cover the financial liability that may arise from an accident injuring a third party. In India, the Motor Vehicle Act was established in 1939. It was amended in 1988. This amendment stipulates that no owner of a motor vehicle can use, cause, or allow to use the vehicle in a public place without a valid insurance. It means that any vehicle which is used in public has to be compulsorily insured against liability risk. These include liability arising from death, injury, or property damage to third party, liability arising from death or injury to workmen such as drivers, cleaners, conductors, laborers engaged for loading and unloading, etc. Liability arising from death or injury to fare-paying passengers traveling in the vehicle licensed to carry passengers. Owners of the vehicle, financiers or leasers who have insurable interest in motor vehicle can insure the vehicle. Types of vehicles. For the purpose of insurance, vehicles are categorized into three types. The first one, private car. These are not used for commercial purposes but solely for social, domestic and private purposes. They are not to be used for hire, racing, carriage of goods or any other business. Motorcycles and scooters. Two-wheelers with similar characteristics as motor cars. Commercial vehicles. These are further classified into goods carrying vehicles. They carry goods under private or public carriers permit. Passenger carrying vehicles carry passengers on hire, for example, auto rickshaws, taxis or buses, and others which are miscellaneous and special type of vehicles like ambulances, garbage dumping trucks, publicity vans, mobile dispensaries, etc. There are two types of motor insurance policies which are available for all types of motor vehicles. The Act Liability Policy or third party liability, which is a statutory requirement. This policy covers the liability as defined in the Motor Vehicles Act. Under this type of policy, the insurance indemnifies the insured against all sums which he may become legally liable to pay any person by reason of death or bodily injury caused to such third parties or by damage to property of third parties caused by or arising out of use of the motor car. The comprehensive policy. This policy covers an entire range of risk as defined in the tariff. This policy is also called the package policy cover. The risks covered are fire, lightning, burglary, theft, earthquake, flood, cyclone, terrorist activity, landslides or rock slides, accidental external means, riots, etc. Loss or damage of accessories is covered only if they are in the motor car. Extra fittings will not be covered unless they are separately described and valued in the policy schedule. The policy excludes mechanical breakdown, failure and breakages, wear and tear, depreciation, consequential loss, overloading of a commercial vehicle and the consequential loss. Benefits of motor insurance. It provides benefits to survivors when an accident results in death. It covers the bills of vehicle repair due to damage caused in an accident. It covers other loss like theft, fire, etc. It provides third-party damage cover also. Extra fittings like music player, air conditioners, etc. can be added to the insurance property in motor insurance. It allows premium discounts. If no claim is made during the policy period, a no claim bonus is offered on renewal with certain conditions. It also provides financial safety for lawsuits brought against the policyholder as a result of an accident. Determinants of risk premium for motor or vehicle insurance. Cubic capacity of the engine. The vehicle which runs on diesel, normal high premium will be charged due to its higher insured declared value, and also the capacity of the engine influences the premium rate. Age of vehicle. The year of manufacturing of the vehicles is one of the factors to determine the premium amount. If the age of the vehicle is more, then the premium amount will be lesser. Geographical zone. The geographic location where the person lives and buys an insurance policy is one of the factors on premium rates. If the person resides in metros or big cities, normally the premium will be high as compared to rural areas. Type of model. High-end cars available in the market will also be insured at a higher premium because the cost involved in maintaining and repairing cars in case of an eventuality will be higher with a higher model. Insured Declared Value or IDV is calculated on the basis of the manufacturer's listed selling price of the vehicle, including price of accessories, after deducting the depreciation for every year as per the schedule provided by the Indian Motor Tariff. This IDV is one of the factors considered when calculating premium. Other factors like personal factors, types of coverage, security system installed also influence the premium amount. Cashless system and claim procedure. Cashless. The first step, the accident or breakdown should be reported to the company. Insurance companies provide cashless repairs across a wide network of garages In order to ensure a smooth ride and free pickup, towing facilities, wash benefits at selected garages. Loss assessment survey of the vehicle within 4 hours by a dedicated relationship manager is provided by the company if informed before 2 p.m. on a working day. This facility is not provided on Sunday and national holidays. 6-month quality assurance on all repairs provided subject to maximum usage of up to 6,000 kilometers post such repairs. If the vehicle is serviced in a garage outside the network, the same can be reimbursed from the company. In case of accident, note the number of the other vehicles involved in the accident. Note the name and contact details of witnesses, if any. Inform the insurance company. Representatives from the company will inform you about the next step, that is, the documents needed for claim and preferred cashless garage. File an FIR in the nearest police station in case of accident, theft, and major damages. After the registration of claim, the company's customer service manager will contact you within 24 hours. He will verify the documents and after the estimation, give spot approval for repair and claim. Documents. In case of accident claim, following documents are required. Claim form duly signed, RC copy of the vehicle, copy of driving license, FIR copy or police copy, original repair bill, any other document as required to investigate the claim. In case of theft claim, along with the above documents, RTO transfer papers duly signed along with Form 28, 29, 30 and 35 and final report. Documents required for third-party claims. Claim form duly signed, FIR copy or police copy, copy of driving license, RC copy of the vehicle. Further documents may be required according to the claim. Some relevant topics. Roadside assistance. One of the services provided by certain companies is roadside assistance. Breakdown support over the phone, minor repairs, flat tire, battery jump start, arrangement of keys, towing on breakdown or accident, arrangement of rental vehicle, arrangement or supply of fuel, message relay, arrangement of accommodation are some of the facilities provided. Garage cash plan. If the vehicle is under repair after an accident, the insurance company will give a fixed daily allowance to the policyholder for the period that the vehicle will be in the authorized garage for repair or for the number of days as mentioned in the schedule, whichever is less. In case of total loss of the vehicle, a lump sum amount as mentioned in the schedule shall be paid. Long-term two-wheeler insurance or LTTW. The IRDA has introduced a long-term policy for two-wheelers, which means the policyholders do not need to renew the policy annually. Instead of 1 year, he or she can opt for 3 years. This insurance, taken for 3 years, is called the LTTW insurance. NCB or no claim bonus. This is a benefit accrued to an insured for no claims during the previous policy period. As per the current norms, it ranges from 20% to 50% on the own damage premium based on successive claim-free years. If a claim is made during the policy period, then NCB is lost in the subsequent policy period. NCB is given to insured policyholders and not to the insured vehicle, which means if vehicle is transferred to another person, then the insurance policy can be transferred to the new owner, but NCB cannot be transferred. However, the original car owner can use the NCB for his or her newly purchased vehicle. Thank you for watching the presentation.